Hi, this is Brian with Current Wave Inc., Chief Elliott Wave Analyst at cwcount.com. This is the chart of the Dow Jones Industrial Average weekly from the year 2000 to this date. Just want to explain how we got here and the events that led up to this today, July 31st, 2019, right before the Fed's action. First of all, really want to discuss the daily sentiment index. As you know, on the dot-com bubble right before, there was a 90% plus bullish sentiment where investors went all in. And as always, the mom and pop investors, the retail investors, their timing is exactly the opposite of how the markets are transpiring. And that the daily sentiment index is very important. Shows you where the turns are that's aligning with the Elliott wave count. If you see here, this top is the three primary counts. You go A, B, C, that's intermediate A, B, C, to finish off primary 4. After this, with Fed QE1, QE2, QE3, we had this tremendous run up from the year 2008 after the great financial crisis, and just had this 11 to 12% return of the S&P 500 for the past decade. That led us to the third intermediate wave in January 2018, and now we have this expanding triangle that's showing up here. I didn't really properly draw the lines, but if you look at the expanding triangle, I draw the trend line for you here as explaining this. This is the expanding triangle right here. Just put that as a white rotation so you can firmly see what's going on. And here is the A, C, and hopefully then we'll get to the E part. And so we have completed A, B, C, D, the expanding triangle in Elliott wave theory. And we're about to go down for 4. This is a very clear and discernible sign. And when the pattern is this clear, it's 90% probability you're going to see this pattern unfold to wave E. But again, investors are going all in, evident by the 90% bullish sentiment in the DSI. But if you look at it here, investors all in, and they cash out at the wrong time after this 9/11, after this debacle, and they do that again where investors went all in right before the great financial crisis, which is the subprime mortgage debacle. Then you go straight down for the primary 4, which is about 60% haircut. So we have this clear 1, 2, 3, 4. Well, not intermediate 4 is not done, but we do have clear 1, 2, 3 intermediate waves. And if you count the subways between the 2 and 3, you see clear 1, 2, 3, 4, 5 minor waves. They took you up to January 2018, and ever since then we've been inside this triangle. So regardless what the Fed does today, you're going to see a tremendous decline that's going to take out the wave C right here, and we'll probably go past wave C low and find a bottom. And I think this is aligning with the final phase, the upside, which is the final 5th intermediate wave, and I think that is syncing with what Donald Trump is going to do next year. In order for him to get reelected, I'm sure he's going to try to pump up this market, and I think this is the Elliott wave is already showing that he's going to do something to prop up this market. So we think this will be the final phase of this 5th cycle degree that completes 5th primary, that completes 5th intermediate. But when you see a turn, usually the bullish sentiment index is way over 90%, and that's what the reading that we got from the DSI, daily sentiment index. So everything is aligning properly here. As you know, the Russell 2000 has never led this market. If the U.S. economy was very strong, the small cap should be leading this rally instead of being falling behind. So it's another assurance or confidence factor that gives us that we do have the right interpretation for this wave V decline. And this should be probably a 3 to 4 months event that's going to take us to wave V. And I think this is a setting up for a tremendous opportunity for the short sellers. So line up your ETFs, inversely ETFs, and based on your risk appetite, you go 2 times, 3 times. There are many ETFs to choose from, but I would not be sitting here on the long side because there is a huge storm coming, and this storm will probably knock off about 700 to 800 points in the S&P 500. Okay, so next time we'll come back to you with another report. Until then, this is Brian from CurrentWave, cwcount.com.